First of all, my congratulations to Business Immo for their 200th edition. It's quite an achievement. And if we go back 20 years into 2004, interest rates were about as high as they are today, in fact. And everybody was happy then, coming down from higher interest rates following the turmoil of 9/11, of the dot-com bubble burst and what have you. So the really lesson learned, I think, for our generation is that we were foolish enough to think that this zero interest rate environment was really going to be there forever. In a way, we were suffering from long GFC, if you like, during that time, and now we've all woken up. So this was an anomaly, and to wake up to that fact obviously causes some trouble in the industry. And the lessons learned is that you should not rely on anomalies, really, but to look at long-term trends, and therefore back to the interest rate levels of 2004. Welcome. We all would like to think that we are experiencing and living through the birth of a new real estate cycle, but to stay within the image, to be quite honest, the baby isn't breathing yet. It's a bit of a harsh comparison. So it needs a bit of a slap on the bottom to start breathing and living and enjoying the new cycle. Because let's face it, the real estate market through this interest rate shock has been deprived of a lot of liquidity, both on the debt and the equity side. So I think we'll still have to see when this rebirth of the cycle really kicks in. The conviction really that you need today is to only act with conviction. And that is hard to find. So whatever we do at present, we only buy very selectively when we have conviction. That is tricky, but we also only sell when we have conviction. It is other people's money. We are trustees for our investors. And therefore, the real approach now is to keep the powder dry until we have that recalibration of the real estate markets. If you look at transactions volumes in France in particular, one of the most liquid and transparent markets in the world, you can't sell anything above 100 million, really, can you? Or only in sort of distressed situations, of which we haven't seen that many. So conviction is to only act with conviction. And therefore, I think we're going to have a few more quiet months before we really kick in again. And that's, I think, the same for our peer group of real estate investment managers. Well, first of all, I think it's good to be asset heavy at the moment. And I really sympathize with the many development companies with great talent and great track record that currently can't really resolve the equation of high construction and finance costs, market rents wherever they are, sometimes quite attractive, but with no real exit option to make the whole equation work out. So to be asset heavy is a good thing. On the other hand, there are challenges, of course, and I think the two biggest challenges for the peer group of real estate investors now with large portfolios is to provide the returns that are still attractive to investors, and their expectations, quite rightly so, have gone up given the interest rate hike and the appearance and the rebirth of interest rate products, and therefore alternative investments to the real estate alternative, and therefore produce attractive performance and returns is challenge number one. And at the same time, even bigger challenges to stay on the decarbonization path of the existing stock that we own on behalf of our investors. Because quite frankly, with all the commitments of both European level, national level, corporate level, and we're actually quite ambitious at Union Investment Real Estate, we still have to produce the returns and the cash flows to be able to decarbonize the portfolio and stay on that path. And I think the combination of these two challenges, that is really something that we're working on very carefully, and that we will have to recalibrate probably strategies and speed of decarbonization given where we stand today to optimize the two equations.